Very good evening to all of you. Welcome to practical session number 16 for the year 2024. Myself, Srijit Kakar, and today is Sunday, 28th of April 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So today's session is the practical application of demand supply methodology. Now, demand supply methodology used to be a paid course, which we were teaching for the last X number of years, but we have made it as an absolutely free course now. In case you have not yet learned demand supply methodology and you wish to learn it, you will be able to find the link to the course content in the description. It's available in both the languages, English as well as in Hindi. So whatever is comfortable for you, you can choose that language and you can learn the complete demand supply methodology. And during these weekend sessions, we will apply whatever you learned theoretically to some practical examples so that we can understand how to plan trades in a very mechanical and rule-based way. Now, before we start with the example for today, we do have two examples from the past which we need to review. So this is the one that we also looked into the last session, I believe. This was session number 14 for the year 2024. It was an MIT trade. And we had a score of 10 out of 10 for quality, but 2 out of 8 for probability, which made it as a type 2, type 3 trade. At the time of analysis, I also talked about that, yes, we do have multiple zones available. We were going with the first one, but I talked about that if I talk about my personal preference, I would like to go with the lowest one. And I also gave you the reason for it. But anyways, we'll go with, what I've given you in the rule book, and based on the rule book, this was valid for us. So you can see, just give us a very small bounce, not even big enough that we could make it as a break-even trade. So after giving us a small bounce, the zone has been breached. So this is closed now. The other one, which is pending for review, just give me a second. Let me also bring that up. All right, so it's gonna take me a few more seconds. All right, perfect. Right, so the other one which was pending for review is this one. This was session number 15th for the year 2024. The session was on 13th of April. And you can see we were inside of the zone when we did the analysis. It was again a type 2, type 3 trade. Quality score was 10 out of 10. Probability was not really high. We only had a score of about 3.5 out of 8. So type 2, type 3, yes, it was valid. But I also talked about that only if we get a deeper entry, because otherwise the reward to risk ratio will not be really nice for this one. And the next challenge also that happened was that almost at the starting of the week, right, we already had that news about the Israel and Iran, right? So if you look into the rule book, I have given you some rules when you have some key events which should have been applied to this setup. But anyways, if you were still looking into this area, then you can see, we definitely went below it. We went a little lower, and then we started getting some reaction from there. So we'll also mark it as a stopped out trade, and that takes care of the only two examples which were pending for review. And now that we are done with the review, we can start with our we can start with our example for today's session. So just give me a second, let me bring that up. So it's just gonna take me a few more seconds, and I am just a second. Perfect. So let's get started. So whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule-based, I have explained this in a video. The title of that video is how to start trading. So again, during the session, if I'm talking about some videos or if I'm talking about some documents, you will be able to find the relevant links in the description. So don't worry, where do I find those documents or where do I find those videos? Just look into the description. Everything is available to you. So yes, that video, which is how to start trading, basically helps you understand why we need to be a very mechanical and rule-based trader. And I've also explained how you should be starting with trading so that, you can become more and more emotion-free, and you can lean more against your rules as you progress through that process. So everyone has to go through that process. maybe once, maybe twice. There is no bypassing it. So the sooner you start, the better it is going to be for you. But since we need to be mechanical and rule based, what we need to do is we need to create a trade plan for us. Now, when you're starting learning trading, or even starting learning a new methodology, it's not easy that from the very first day you can create a trade plan for yourself. And the reason for that is the lack of experience. Only when you have good enough experience with that methodology, it's easier for you to create a trade plan. So to overcome this challenge, I have created two documents for you. The first one is the trade plan steps, and the second one is the rule book. So we use the combination of these two documents during this weekly practical session so that we can learn to plan trades very mechanically and rule based. So what is our step number one when we start planning our trade? Step one is to define the trade purpose. Now, what do we mean by trade purpose? Trade purpose implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So the question is, why are we starting with the trade purpose? And the reason for that is, when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that we have so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days, but keep it at the back of your mind if you're trading markets which are not 24-hour markets. That I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up, some they gap down. And because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting. But on the downside, if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that keeping a position overnight always has that inherited overnight gap risk, which we would like to avoid initially, because when you're learning something new, like I said, it's the lack of experience due to which you might be making some mistakes. So we don't want to take that unnecessary overnight gap risk initially. So initially our hourly dailies will be strictly intraday trades. Now for weekly monthlies, anyhow, we're not expecting to get the exit the same day, though at times it might happen. But this is where we definitely are expecting the trades to last for a little longer duration of time. But that does not imply that for weekly monthlies we cannot have gap against us. It can still happen. But since we are leaning against a bigger time frames, the probability definitely reduces. So what I need to do as my step number one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have opted my trade purpose, what is going to happen from the rule book, I'll get to know what time frames I should be using. Now, this rule book that I've shared with you is a conservative approach. With time, with experience, if you want to make some modifications to it to make it better suit with your personality style, you can definitely make those modifications. So on page number 28, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. The higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Just give me a second. All right, so just a minute, let me fix this. All right, perfect. Great. So yes, we talked about the 4 different time frames, and we already talked about our 4 different trade purposes, which is HIT, DIT, WIT, and MIT. So now the question is, for every purpose of trade, what will be my 4 different time frames, and we get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then the refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Next comes challenge number 2, and the next challenge is I do know my time frames, but on NSE, like in this example, we have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need to do now is I need to have a process in place for selecting scripts so that I have a smaller list. If I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every day, it's not an easy task. So how do I get that small list? For this, we use certain computer programs which are called as scanners or screeners. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you which are based on some moving averages. They can help you in shortlisting symbols. Example 2, if you go to my YouTube channel and search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples using which we can get a smaller list, but you're not restricted only to these 3-4 scanners. Let's look at few examples before we move ahead. So like I was talking about, that once you go to our website, under the free tab, you can see you have the stock screener option. Because I want to plan MIT trades, I can click on the long scan and the short scan under MIT. So here you can see for the long scan, it is shortlisting 1 symbol for me, and for the short scan, it is shortlisting 5. Now, very important, whenever you're using these scanners or screeners, irrespective what scanner screener you're using, whatever results you get, you can never blindly buy or sell these stocks or whatever markets you're trading. And the reason for that is the job of the scanner is not to tell you what you need to buy or what you need to sell. The job of the scanner is I can't analyze 2000 companies every day. So you can see out of 2000, it gave me a list of 6 symbols. So what I need to do now is analyze these 6. If any of the symbol out of these 6 they match with my trade plan, then it might be a trading opportunity for me. But if nothing matches with my trade plan, I don't have anything available to me. So again, very important, scanner screeners, they never tell you what you need to buy or sell. They are just helping you get a smaller list so that you can do your analysis on it. Now, many times what can happen is your list might be a very small list like you can see today, or maybe it is not shortlisting anything because nothing is matching with these conditions. So if something like this happens, or even otherwise, if you want to have a little bigger list so that you can look at more number of symbols to identify your opportunities, then what you can do is out of these 5 conditions which I've given, you will disable the third one. You'll run the scan again, and I'll do exactly the same thing here. I'll disable the third one and run the scan again. And now you can see that initially it was giving me a result which was only 1 symbol, but now it is giving me about 32 from here. And if I go to the short scan, we have 27. So we have 32 plus 27, which is 59 symbols to look into. So it's not that you have a list of 500 or 600 symbols to look into. It's still a very small list, just about 59. Which I can say can easily be analyzed in about maybe half an hour. And this is not the only scanner available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available on this particular website. Some of them are based on fundamental analysis. Some of them are based on top left. Then you have your candlestick patterns. Then you have your range breakouts. You have your bullish scan. You have your bearish scan. If I further go down, intraday bearish, intraday bullish, crossovers. So you have n number of scanner screeners available to you using which you can get a smaller list for you. and that is what you need to do as your step number 2. You need to get a smaller list. Now in this example you saw that we got a list of about 59 symbols. Now when you start analyzing them, there are few challenges which you will realize. Challenge number 1, what you will realize is that majority of these symbols, they don't have a quality demand zone or a quality supply zone on the lower time frame, and the reason for that is because all these 150,000 plus scanners that I showed you, they are either based on conventional technical analysis or fundamental analysis. They have nothing to do with demand supply methodology. So that is why just because something is getting shortlisted does not guarantee that on the lower time frame you'll have a quality area available to you. So in a way you might be wasting a lot of time analyzing symbols where nothing is available to you on the lower time frame. That's the very first challenge. Second, if few symbols they do have some areas of demand and supply, those areas might be really far away from the current market price, due to which you might have a longer waiting period before the prices are back to your zone and you can participate. And during that waiting period, whatever price action develops, that might disqualify that trade setup. It might not match with your trade plan by the time it is back. So that is also another challenge, that your current market price might be far away from the zone. So to overcome these challenges, I've also created two custom built tools. One is called as the alert service, the other one is called as the screener. Again, mind it, these are not call giving or tip giving services. These are again scanner screeners. Only difference being that these two scanner screeners are purely based on demand supply zones. Now the link to the walkthrough videos for both these tools, which is the alerts and the screener, is available in the description, but I'll quickly show you how they basically work. So for the alerts, we do have a demo channel available for NSE, for MCX, and for Forex. And you can see that for half an hour during the live market, we do provide some demo alerts. And these alerts are generated as soon as the zones are formed. And for the NSE, we give those alerts from 11:15 to 11:45 Indian Standard Time. So you can see on the demo channel on the 26th of April, we had an alert at 11:15 that we have a rally-based rally zone on IEX on the daily time frame, for which this is the proximal value, this is the distal value. Similarly, on ICICI Bank, we have a drop-based rally again on the daily time frame. Similarly, if I go down, you can see Europharma, you have rally-based drop on 15 minutes proximal distal. Right. Similarly, if I go down, you can see now these are the alerts for 5 minutes time frame. This is again for the daily time frame, again for the 5 minutes time frame. So you can see as and when these zones are getting formed, you immediately get notified, which basically implies that your current market price will always be close to the zone, because as soon as the zone is getting formed, these alerts are getting generated. But again, I'll add, it's not a call giving or a tip giving service. It's simply a scanner which is helping you shortlist based on the formation of demand and supply areas. If you wish to join the demo channel to experience it, like I said, once you go through the walkthrough video, you will get to know where those links are available, and you can join the demo channel, you can experience it. Similarly, we have another tool which is called as the screener. Now what the screener basically does is, like in this example, you can see that in the screener I have given about 40 symbols, and I have given the condition that whenever the current candle is within 1% proximity to a demand area or a supply area, just shortlist that particular symbol for me. Now the difference is that for the alerts, you only get notified for the zones which are getting formed on that particular day, right? So it has nothing to do with what has already happened in the past. But what the screener basically does is, whether zone was formed today or whether the zone was formed a week ago or a month ago or a year ago or a decade ago, as long as the current candle will be within 1% proximity of that zone, it will get shortlisted for you. So you can see it is telling me that out of those 40 symbols, only currently Maruti is within 1% to a supply area. And because I've applied it to the daily time frame, it's telling me for the daily time frame. So if I go to Maruti, you will see that we will be having a supply zone, and our current market price will be within 1% proximity to that supply zone. So let's just give it few seconds. The indicator is loading, and now you can see that is where you have your supply. Similarly, if I just go to NTPC as an example, you will see that on NTPC will be having a demand area, and my current candle will be within 1% range to that demand area. So here you can see you do have this area which is a drop based rally, and you can see my current candle is within that range. So this is what these scanners they basically do. They help you in shortlisting purely based on demand supply zones versus conventional technical analysis. So at the end of the day, it's your call how you want to get that small list. I showed you n number of ways of doing it, over 150,000 scanners which are either conventional or fundamental based, two scanners which are based on demand supply zones. This process can also be as simple as I don't want to use any of these scanner screeners. I just want a small list, so I will only be analyzing my Nifty 50 stocks every day. Or maybe you have your own favorite list of stocks which you might want to analyze every day. So choice is yours how you want to get that small list, but you'll have to use one or the other way to get that list, because if you don't have that, you don't know what you need to analyze. So let's assume whatever process you applied, you got a list, you already have your time frames from your step number 1. So what we need to do now is we need to go to the lower time frame. So the question here is, what is my lower time frame? So as a monthly income trader, we got to know that our lower time frame will be daily. So I'll go to the daily chart and identify zone. By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go to the daily time frame. So let's assume this was the very first symbol in that list. Now, as of now, I have applied the demand and supply zone indicator. Now, when you talk about demand supply methodology, always say it's a price action based methodology. So as an example, if I zoom out a little bit and remove all these indicators, you can clearly see that the prices, they moved up, they paused and started moving up. And that is what we call as a rally-based rally structure. Now, even if I apply the boring candle indicator here, you can see this candle is boring, this one is exciting, this one is exciting. So even based on boring exciting technique, you do have this rally-based rally structure available to you. But the demand supply zone indicator definitely makes the process much more convenient, easier and faster for us. That now we don't have to identify the zones. It automatically identifies the zones for us and plots these zones for us. And that is what it is doing as of now. So you can see the indicator is telling us that we do have a rally-based rally structure available here. Just give me a second. So let's draw the zone. So that's our rally-based rally. So my step number 3, which was to identify a zone on the lower time frame, is now complete. Do I have a zone available? The answer is yes. Now, once you have identified the zone on the chart, does not mean you can blindly trade it. The next step is to qualify it, and for qualification we have a 2-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify it based on the booster scoring. So the first thing we'll check is that is the zone a case of level on top of level. Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, as a monthly income trader, my intermediate time frame is weekly, and you can see on the weekly we don't have any zone available to us. So it's not a coinciding level, and because it is not a coinciding level, it cannot be a case of level on top of level. So level on top of level, not applicable. This zone is not because of a gap, therefore gap rules will also not apply. Pivot nor authenticity not applicable, because pivot nor authenticity we only apply to drop based rallies and rally based drops. And it is also not a structure of unstable equilibrium. You can see it here that the leg out is not going below the basing. Only if the leg out was going below the basing, we would have called it as a unstable equilibrium structure. So if you look at all these conditions, none of these conditions were applicable, and if these conditions are not getting applied, they cannot disqualify the zone, because to disqualify the zone, first they need to be applicable. Then there are 2 possibilities, either qualified or disqualified. But if not getting applied, the zone cannot be disqualified. So now we know we do have a qualified zone available to us, but you still can't trade it blindly. The next step will be its booster scoring. So starting with the first one, which is freshness, the zone is definitely fresh for us. You can see after leaving the zone, price has never been back, gets a score of 3. Strength, we have an explosive move. That's the reason the indicator is identifying it for us. I think I have given my settings as a good move, right? So if I just change it to explosive, let's verify. It's not an explosive move. It's a good move, right? So for good move, what I'll do is I'll give it a score of 1, right? So I actually didn't realize that my settings is not explosive, it is good. So I'll give it a score of 1. Next time at the zone, we do have 1 candle, gets a score of 2 again. Reward to risk ratio will be an assumption. So it's a high quality zone, gets a score of 9 out of 10. Now talking about the location, something to learn again from here. You can see if I go to the monthly time frame, I'll have n number of demand areas, but we don't have any supply. Now this is not even a symbol which is making all-time highs. So if it is not making all-time highs, because all-time highs will only be once this high is breached and then it starts moving up, that is the time we can apply the rules of all-time highs. We can't apply it as of now. So what do I do in such a case? You have two options. Option number one, as a very conservative trader, you might say, okay, since I don't have a supply area to complete my curve analysis, I would skip this symbol and I'll analyze another symbol, right? That's the very first approach, which is the most conservative one. The other one is, okay, I don't have a supply area, but I do understand that if I start looking from, the current market price and start looking up and trying to identify where was the most recent pivot high. So you can see that is where we had a really nice strong move to the downside, and that's my most recent pivot high. Now, logically, if the prices they move down from here, there could be only one reason, and that reason has to be supply. The only thing is that supply is not available or visible on this particular time frame. But if I go to a different time frame, let's say if I go to weekly, I might be able to see that somewhere around here I might have some areas of supply, and you can see we do have some areas of supply here. So yes, the only thing is we understand logically there has to be some supply. It's just that it was not formed as a structure on the monthly time frame. So in such a scenario, if I want to do my analysis, I can take this pivot high as a reference point and I can do my curve analysis. And now you can see I have 4 divisions instead of 5, which is very low of the curve, low of the curve, middle of the curve, and high of the curve. The only thing that is missing is very high of the curve, because we didn't have a supply zone to mark the very high of the curve. But I can still do my curve analysis. I am planning my trade low on the curve, which is a good location to plan a long trade. Therefore gets a score of 1. And if I go to the weekly time frame for the trend analysis, you can see the indicator is telling us we are in a sideways trend, which gets a score of 0.5. Now move from the zone, we need minimum 4:1, which has already happened. You can see 1:1, 2:1, 3:1, 4:1. So we have definitely gone a tad above 4:1, gets a score of 2. It was not a case of level on top of level, not even coinciding. But for trap, I can again give it a score of 1, because you can see if I just take a horizontal line somewhere around here, it has been beautifully acting like support, acted like resistance, again almost acting like support. So people who believe in support resistance will be very interested in buying with their stop losses placed below, which will be sell orders. And similarly, if we again have a breakout traders will also sell. Therefore, by the time we are into this area of demand, we'll have a lot of selling coming in, and these people are making 2 novice mistakes, selling after a decline in price into an area where the chart has proven to us that back in history demand exceeded supply, which is the only reason for prices to move up. So yes, it can work like a trap. Therefore, we'll give it a score of 1 for it. So if you look at the overall scoring, we have a score of 9 out of 10, which makes it as high quality, and 4.5 out of 8, which makes it as high probability. And high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this can be done as a type 1 trade. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So you need to be ready for the worst case scenario, for which you'll do your proper position size calculation. Whenever the prices are back, you'll have to re-verify, because markets are not static, they are dynamic. Conditions are changing almost every other second. And if the trade is still qualified, you will place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step will be trade management, where step 1 is 1:1, you make it as a break-even trade. And after that, if you get the opportunity to trail onto it, you start using your trailing stop loss. So this is how we plan trade, very mechanically, very rule-based, and that takes care of today's example. Now, before we move ahead with the queries I have in the chat box, a few things I would like to add. One, I apologize for the last week. I know I was not able to schedule the session. Generally, what I do is, in case I'm not available, I do take it on some other day, maybe on Friday or Saturday. But this time I was not able to do that as well, so I really apologize for that. But yes, it's a rare case scenario. And next, if you people are not subscribed to my channel, do ensure you subscribe to it. If you're on some trading groups, or if you have any friends or family members who are interested in learning trading, you can share the link to my course with them. You can also share the link to these videos. It might help them understand trading a little better. So let's see what we have in the chat box now. So in Forex commodities market, should we mark zone on the 6 hours or the 8 hours? See, Pratik, eventually you will realize that a time frame in itself does not have a lot of weightage initially, right? Initially, what has a lot of weightage is that you are identifying quality areas. Now, once you have started identifying quality areas, irrespective whether it is on 6 hours or 8 hours, doesn't make any difference. But I'll give you a small little hack which you can use to define what your time frames should be, and that is what you will see is constant with the these time frames I've given you. So whenever you are selecting your time frames, always go for something which is a multiple of minimum of 3 times to a maximum of 6 times, right? Nothing less than this, nothing more than that. So what do I mean by it? So you can see if I'm on my refining time frame multiplied by 3 is my lower time frame multiplied by 4 is my intermediate multiplied by 4 is again my a higher time frame. And you can see after 240, if I again multiply it by 6, right, that becomes my daily multiplied by 5 is my weekly multiplied by 4 is again my monthly. So by keeping this in at the back of your mind, that when you're selecting your time frames, minimum multiple of 3, maximum multiple of 6, you can choose whatever time frames you wish to, but make those modifications in a way so that you're not going less than 3 times the multiple or not more than 6 times the multiple. So that is the only thing you have to keep at the back of your mind. All right, let's see what do we have next. Can you explain, please explain the following from the rule book. Price comes to the zone from high time frame demand supply. When the price comes back to your zone after hitting the very high, very low of the curve, the probability. Okay, see what that basically implies is that now let's, in fact, what I'll do is I'll just do some annotations that will make it much more easier to understand. Just give me a second. Perfect. So now if you think about it, the way we are planning our trades is something like this. We have our very high of the curve, we have our very low of the curve, right? So basically this is my higher time frame demand zone, and this is my higher time frame supply zone, right? Then what is happening is that on the intermediate time frame we have some trend, right? So let's imagine this is my uptrend on the intermediate time frame, so that's my ITF uptrend. And then on the lower time frame I have identified a demand area, so that's my demand area of the lower time frame where I would like to participate. Now the reason I want to participate is this is what we are anticipating, that this trend can continue unless and until it hits this supply area. Now many times what might happen is prices might retrace to your demand area, and then this move continues, and now two things can happen. Either this supply will again push the prices lower, or maybe the supply gets violated and prices they continue with the move to the upside. But many times what happens is that the prices, they do not come back to your zone and they just continue moving up. And after hitting the very high of the curve, then it starts retracing back to your zone. So this is what that rule is all about, that if the prices have not been back to your zone, they go and hit the very high of the curve and then they start coming back to your zone. That reduces the probability of that trade setup, right? So that is what this rule is all about, that if you see something like this, ideally it's better to avoid such a zone. But yes, then I have given you some rules. If you want to add those rules to bring in some extra positive factor to that zone and then you want to trade it, you can add those positive factors to trade it, right? But basically that's the scenario which that rule is talking about. Just give me a second. Perfect. All right, so price comes from the high when so I have already answered this. How is freshness given a score of 3? The zone does not look fresh. See, if you look into this zone, the zone is definitely fresh, because even if you talk about the proximal line, you can see even from the proximal, from the proximal, definitely it is fresh. But even if you look at the entry price that I've drawn, this candle has not yet hit that entry price as well, right? There might be a very small difference. So that is the reason I have given it a score of 3. Can you see if I zoom in? Probably you might be able to see it now much more clearly, that we have still not hit the entry price. And yes, we have been pretty close to it, but again, coming back to the proximal line, from the proximal, definitely it is still a fresh area. Sorry, watching on my phone, so not sure, and apologize in advance for it's perfectly fine, right? You don't have to apologize for anything. That is what these sessions are all about, right? If you have any challenges, if you have any questions, queries, feel free to put it in the chat box, Aman. All right, so you make trading so simple with all the knowledge. All you need is patience. Absolutely. In fact, what I will add here is, if you don't have patience, trust me, trading will be a very big challenge for you. And the reason for that is, you don't have beautiful opportunities coming up every day, right? Unless and until you're looking at a vast array of symbols that are available to you and you're trying to identify from them. So generally you will have to have a lot of patience for that perfect setup to show up, which is an exact replica of your trade plan. But eventually what you will also realize is that trading is also not about taking a lot of trades, right? Eventually you'll realize is trading is all about having patience, taking very few trades, and you will realize that those few trades make you much more money versus when you were trying to force yourself into every other trade. So that is just a transition that happens as you start growing as a trader and you start seeing those results. But definitely patience is one of the key characteristic of a successful trader, is what I'll say. All right, perfect. So that brings us. Okay, so when will we chance to see? See again, these sessions which I'm doing now, the recordings are available, so they are as good as your recap. So you can watch these sessions as many times as you wish to. And yes, the previous sessions which were available through our website, they are no longer available now. And since we have shifted to these sessions via YouTube, so these sessions are getting recorded. They will be there forever. So whenever you want to do a recap, you can just go through these sessions and you can watch these sessions over and over again to help you understand if there are any challenges you're facing with your analysis. And anyways, even if you're facing any challenges with your analysis, or if you have any questions, queries, you can always join in live, because I do these sessions every weekend, and you can put your questions in the chat. And even otherwise, you can also put your questions in the comment section, because I try to answer as many questions as possible which are asked by you people. Those of you who are not able to join live, those of you who are watching the recordings, you can definitely put it in the comment section. All right, so that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now the next weekend. Till then, trade safe, enjoy your Sunday evening, take care, bye bye.